Welcome back to Synaptic Dividends. All right, today we're tackling an absolute giant, Walmart. We've all been in the stores, right? But for us as investors, there's a much bigger question. Is that dividend we hear about a rock-solid source of income, or is it kind of getting past its prime? Let's dig in.
Yeah, that's the real question, isn't it? Is Walmart's dividend still a dependable shopping cart titan? Or, after so many years, is it starting to lose a little steam? Well, the answer really comes down to just a couple of key numbers, so let's jump right into the most important one.
You know, for any of us investing for income, everything, and I mean everything, starts with safety. Before we even think about growth or yield, we have to know, can the company actually afford to pay us? And believe it or not, there's one number that tells us pretty much the whole story.
It's called the free cash flow payout ratio. Now, don't let the fancy name scare you off. It's actually super simple. Think about your own budget at home. Free cash flow is like the money you have left over after you've paid all your bills and expenses. For a company, it's the real cash profit that's left. This ratio just tells us what percentage of that leftover cash gets sent out to us, the shareholders. A lower number here means a bigger safety cushion. It's that easy.
So what's the magic number for Walmart? It's 68.4%. So for every single dollar of pure cash profit Walmart makes, only about 68 cents goes to the dividend. That is a really, really healthy number. It leaves a ton of cash left over to reinvest, handle surprises, or, just build a bigger war chest. From a safety point of view, this is exactly what you want to see.
Okay, so we've established the dividend is safe. Check. That's awesome. But that's only half the story, right? The other half is all about growth. And with Walmart, this is where things get really, really interesting.
52. Just let that number sink in. For 52 consecutive years, Walmart hasn't just paid its dividend, it has increased it every single year. That puts it in this super elite club called the Dividend Kings. I mean, think about that. Through every recession, every market crash, every boom, for over half a century, shareholders got a raise. That is an unbelievable track record.
But here's the twist. For a long time, that growth was, let's be honest, kind of slow and steady. The 5-year average was just over 3%. Nice and reliable, but not exactly exciting. And then, bam, something changed. Last year, the dividend grew by over 9%. That's nearly triple the recent average. This isn't just a little bump, folks. This is a massive acceleration. It signals that something new is happening.
So let's put all the pieces of the puzzle together. On one hand, we have a dividend that is incredibly safe. And on the other hand, we have growth that just hit the accelerator. So what's our takeaway as investors?
The numbers really couldn't be clearer. Walmart's dividend is not some tired old titan. It's a dividend king that's not only super safe, but it's suddenly found this whole new gear. That recent 9% hike completely changes the story, making Walmart a much more exciting name for income investors to look at right now.
Look, these numbers tell a really powerful story, but they are just one part of the picture. If you want to go deeper and understand the full business model, the competitive advantages, and the risks behind these trends, check out our long-form analysis on our main channel, Synaptic Investing. Because the real question now is, can this new growth spurt continue?